All right, and staying with earnings stories, Aritzia has been a TSX standout this morning. It is now up 15%. That is quite an intraday pop after some well-received quarterly results. Luke Hannan joining us now to talk a little bit more about Aritzia's business. He covers the retail sector. He's with Canaccord Genuity, where he's a vice president of research for consumer products. Nice to have you with us, Luke. First of all, when you look at the Aritzia business, what would you say is going right?
Well, certainly there are a lot of things that are going right for Aritzia. I mean, namely, most importantly, they are seeing robust momentum on both sides of the border when it comes to demand, and also when it comes to both their new boutiques as well as the e-commerce channel as well. Specifically, when it comes to their boutiques, they opened 3 flagship locations towards the latter part of the year, which were borne out in the numbers that we saw last night. And the robust growth in the U.S., I mean, 56% growth year on year. That includes both in-store and e-commerce. That just speaks to how well they're executing right now. And I think what differentiates Aritzia compared to the rest of the apparel retail space, particularly this earnings season, is the fact that that momentum to close out their fiscal year has thus far continued into Q1. That's a bit of a differentiator versus other folks.
So if we were to take a look at Aritzia's stock, anyone who tracks it closely would know that the shares had a tumble earlier in the year. And I think for a lot of retailers, there were just so many uncertainties out there that, you had to wait and see what the companies would be able to do. And so when you get quarterly results or outlooks, as we are getting during earnings season, investors can say, okay, well, things look pretty interesting. And, some of what you're talking about, Luke, I remember when they went public and they had those big ambitions to grow in the U.S. So there's a lot of the long-term plan that is working. But I still remember when Aritzia had that really rough 2022. They were dealing with all sorts of issues. And now you've got a company that since the fall of, I want to say 2023, has been one of the best performing stocks in Toronto. So what have they been able to work through in these years as a public company that allow them, I guess, in a time of uncertainty to deliver a strong quarter like this, in your opinion?
Yeah, what's differentiated them over the course of the last year or two has been this focus on newness. So this period that you're referencing before, John, where the stock was under pressure, a lot of that had to do with the fact that they were simply just trying to keep up with the demand that they were seeing at the time for existing product. And so they didn't have quite as much of a focus on newness as maybe they had previously. But then since coming out of COVID, there's been more of this focus on introducing innovation within the assortment, which has responded. Aritzia's clientele has responded quite well to it. So now they've got that back on track. And more recently, the dip in the stock, to your point, has been more attributable to what's going on from a tariff perspective. We got a little bit of clarity from the company on that last night, mentioning that in totality, it's a 400 basis point impact to EBITDA margins, but they are going to be able to mitigate roughly half of that through both internal measures, cost savings programs, as well as working with their suppliers to help bear out some of that cost as well.
Okay, that's really helpful context. And we've lived, I would say, for the last decade at least, in an environment where, if we're going to talk about retail stories in the stock market, generally speaking, completely generalizing here, but companies that have more control over how and where their goods are sold get more attention. And, as we were covering the Aritzia results, we were talking about how there were some encouraging signs at the stores, but there was also some encouraging signs online. Can you explain how they have built the business to benefit from sort of both of those trends of controlling your own destiny, which I think makes even more headlines at a time when you're seeing what's happening to like Hudson's Bay, for example?
Certainly, yeah. Maybe we can start with the in-store experience. What we've noticed is since the IPO, and absolutely more recently, the average square footage of an Aritzia boutique has grown substantially over time, to the point now where some of the flagship boutiques that they've opened in recent months are in the neighborhood of 30 to 40,000 square feet. Whereas if we were to go back around the time of the IPO, the size of the average boutique at that time was 6,000 square feet. And the reason for this being that, simply put, the demand for Aritzia product was so strong that they needed to have more space to be able to offer the full, broader assortment, but then also more space for clientele to be able to come in and try on the product within fitting rooms as well. The demand was so robust, they wanted to make sure that there was enough space to be able to house both enough product and clientele. And that's a strategy that has absolutely paid off. The productivity of these locations is robust, to the point where if we look back over the course of the last 12 months, the paybacks on all the boutiques that Aritzia has opened in the US, the payback periods have been 12 months or better, which is unparalleled within the apparel retail space. Most times you'll find payback periods in and around 24 to 36 months. Again, Aritzia is doing this at 12 months or better.
Okay.
When it comes to
go ahead.
When it comes to the e-commerce space, what's really interesting is that in the past, so Aritzia's boutiques has been its best form of marketing, to the point where they get a lift in e-commerce revenues within a given region whenever they simply introduce boutiques in that given region as well. It's only been more recently that they've invested a little bit more in digital marketing, specifically paid search, and that has absolutely paid off when it comes to the level of e-commerce growth that they're seeing right now. So it's a strategy that we expect that they'll continue to deploy over the course of the next 1, 3, 5 years.
Okay, so against that backdrop, I think generally on Bay Street, Aritzia has been a well-liked name. So when you put all the pieces together and you try to value the business, do you think there would be upside for the shares from here?
We do, yes. Certainly in the multiple perspective, we look at this on an EV to EBITDA basis. It's certainly nowhere near the peak of what it is that we saw when we think about 2 or 3 years ago. Now, at this point, remember, this is a valuation that's based on now an outlook for the year, which does appropriately and conservatively, in our view, bake in expected tariff impacts. It's worth noting, should we get any positive resolution in U.S.-China trade tensions, that should bode well for Aritzia's business going forward. And by extension, it would make the current multiple that it trades at, being around 12 to 13 times EBITDA, that would certainly make it look even more attractive. And like I mentioned, even at 12 to 13 times EBITDA, it trades at a discount to what we consider to be the peak multiple for this. So in other words, when we take everything together, the Q1 momentum to date, the fiscal 26 guidance, that bakes in a relatively healthy degree of conservatism in our view, very strong unit economics when it comes to the stores, we think that is a very appropriate valuation for the stock today, and it's compelling from a long perspective.
Luke, nice to have you with us. Appreciate the breakdown. Luke Hannan joining us from Canaccord Genuity to talk about the Aritzia stock story, and we'll continue to track that today. But beyond retail, we're going to have our hot picks segment coming up, and we're going to talk about commodity-related stocks. There's a wide range of opportunities out there, but we'll zero in on 3 potential plays for your portfolio. That's next.